Investors in the stock market are starting to feel uneasy. Is it due to the Federal Reserve warning about a slowdown? Or concerns about inflation and tariffs? Surprisingly, that's not the biggest worry right now. There's a powerful economic signal flashing red, one that has predicted nearly every major recession for decades. Let's break it down and understand what's happening. Wall Street uses various economic indicators to forecast recessions. Some prove accurate, while others signal downturns too soon. But there's one that economists, investors, and even the Federal Reserve monitor closely: the inverted yield curve. This indicator has successfully predicted every recession since 1955, except for a few exceptions, like 1966 and 2022. While 2022 technically met the criteria for a recession, it was never officially declared as one. Now, the inverted yield curve isn't foolproof, but it's a key measure of investor confidence. It works by tracking shifts in short-term versus long-term investments. When investors move away from short-term options and lock their money into long-term holdings, it often signals concern about the economy's near-term future. Let's simplify this concept. When you invest, you have options: stocks, real estate, gold, cryptocurrency, or bonds. A bond is essentially a loan where you lend money to a corporation or the government in exchange for interest. Lending money to the U.S. government is called buying a treasury security, and these come in three types: treasury bonds, 20-30 years, treasury notes, 2 to 10 years, treasury bills, 1 year or less. The interest rates on these depend on supply and demand. Normally, long-term investments pay higher interest because they require you to commit your money for longer. But right now, something unusual is happening. The yield on short-term treasuries is higher than on long-term ones. Why does this matter? When short-term interest rates exceed long-term ones, it means investors are pulling money from short-term investments and parking it in longer-term, safer assets. This signals fear and uncertainty about what's coming in the next few months. Historically, this pattern has often preceded a recession. We're currently seeing this inverted yield curve in action, and it's raising alarms across financial markets. Beyond this, our economy is facing multiple uncertainties: trade policies, inflation, emerging technologies, and shifting global trends. The stock market hates uncertainty, and right now, uncertainty is everywhere. This has led to volatility in both stock and cryptocurrency markets, with investors seeking safer options. But here's the truth: recessions are inevitable. They happen as part of the economic cycle. Over the past century, we've seen 16 recessions, an average of 1 per decade. While no one can predict exactly when the next one will hit, we know it's coming. So, what should you do? The key is to prepare, not panic. Many investors lose money in recessions because they react emotionally. But the wealthiest investors capitalize on downturns, buying assets when prices are low and watching their value grow over time. Smart investing means having a strategy. Whether you prefer long-term passive investing in the S&P 500 or tracking market trends for unique opportunities, consistency is key. Keeping cash reserves, having liquidity lets you seize investment opportunities when prices drop. Understanding market cycles. Booms and busts are part of the system. Those who plan ahead come out on top. Historically, some of the best investments were made during economic downturns, whether in 2008, 2020, or even 2022, when markets saw brief pullbacks. Bottom line, markets will rise, fall, and sometimes stay sideways. The most successful investors don't try to time the market perfectly. Instead, they build long-term strategies that work regardless of economic conditions. Want to learn how to take advantage of market shifts? Stay updated with Wealth Leap for insights on investing wisely and growing your wealth, no matter where the economy is headed. If you found this video helpful, hit the like button and subscribe to Wealth Leap for more financial insights. Also, let us know in the comments, how are you preparing for the next market downturn? We'd love to hear your thoughts.